Welcome to the Pirls Stock Market Commentary, your weekly window on stock market technical conditions featuring the proprietary bull bear point and figure market breadth summary chart for June 18th, 2017. Market breadth. With this past week's market decline, our bull bear point and figure ratio at 1.22 fell slightly from 1.27 last week, remaining within bullish territory. The total count of securities in bullish or bearish patterns decreased 2% to 3,014. The count of bearish stocks decreased fractionally, while the count of stocks in bullish patterns decreased 4%. The Pirls PNF Market Breadth Summary Chart shows us a market now 4 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To subscribe to the weekly Pirls Stock Market Commentary via email, free of charge, simply enter your email address in the space provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 1 point for the 6th advance in 8 weeks. At a positive 161.33 points, it continues below all 6 tops above plus 100 and continues above all 5 bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in distribution mode with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 1 accumulation day and 3 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in distribution mode on higher average daily volume. Momentum, now at negative 77.17, down from a positive 41.06 last week and dropping below plus 100 at Friday 6/9 close. The CCI 20 Daily Woody's CCI Uptrend Zero Line Reject Long Trade Simulation ended at Monday 6/12 open with a gain of 55.31 points on the Nasdaq Composite, or 65 cents per share of QQQ. The trade began at Friday 5/19 close, forming a valid Zero Line Reject Long Entry signal for Monday 5/22 open. The CCI 20 Daily now continues in a Woody's uptrend, but with 3 consecutive days below zero. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 59 weeks ago, while the daily CCI 20 began a Woody's uptrend 30 weeks ago. The CCI 20 weekly has fallen to 93.60 from 135.40 last week. We await the return of the CCI 20 weekly to the plus or minus 50 range for another CCI 20 weekly potential trade. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: brokers, banks, and oil on top, gold and silver, retail, and some tech on the bottom. Bullish, brokers and KBW Bank continues in the top 5. Bearish, semis, and disk drives have entered the bottom 5. Gold and silver has re-entered the bottom 5. Comp Tech, disk drives, and S&P retail continue in the bottom 5. Networkers has left the top 5. Oil services has left the bottom 5. Focus this week from www.zerohedge.com. Deutsche Bank. The market's current metastability will lead to cataclysmic events. The following are some key points and diagrams. With the VIX slammed at the close of trading on Quadwich Friday, sending it just shy of single digits once again, and pushing stocks back in the green in the last seconds of trading, the much-discussed topic of near-record low volatility simply refuses to go away, which means even more attempts to 1. Explain it, 2. Predict what ends the current regime of endemic complacency, and 3. Forecast the catastrophic damage to markets when it does finally end. Overnight, applying his typical James Joycean stream of consciousness approach to capital markets, Deutsche Bank's derivatives analyst Alexander Kochik penned his latest metaphysical essay on this topic, which covered most of the above bases, and which postulates that far from stable, the current market equilibrium is one which can be described as metastable, the result of widespread complacency, and which he compares to an avalanche. A totally innocuous event can trigger a cataclysmic event. He also inverts the conventionally accepted paradigm that lack of volatility means lack of uncertainty, and writes that, to the contrary, it is the ubiquitous prevalence of uncertainty that has allowed vol to plunge to its recent all-time lows, keeping markets metastable. Complacency encourages bad behavior and penalizing dissent. There is a negative carry for not joining the crowd, which further reinforces bad behavior. This is the source of the positive feedback that triggers occasional anxiety attacks, which, although episodic, have the potential to create liquidity problems. Complacency arises either when everyone agrees with everyone else or when no one agrees with anyone. In these situations, which capture the two models of recent market trading, current and the QE period, the markets become calm and volatility setting and carry strategies define the trading landscape. But calm makes us worry, and persistent worrying causes fear, and fear tends to be reinforcing. Such metastability is in itself unstable. Persistence of low volatility causes misallocation of capital. This is how complacency leads to buildup of risk. It is the avalanche waiting to happen. Unlike Kolonovich, who quantifies the metastable regime's thresholds in terms of VIX, warning of catastrophic losses for vol sellers once VIX rises above 15, Kochik instead merely qualifies the factors that build up in the final phase of the metastable regime, eventually spilling over, as shown in the chart above, forcing its end in a violent burst of volatility and a market crash. Endemic complacency, which continues to take hold of the markets, is likely to play an increasingly adverse role the longer markets continue to operate as they recently have. However, although volatility remains depressed, the risk continues to be pushed to the tails. This is a buildup of metastability. The longer the stick, balanced vertically on top of a finger, remains still, the more surely it will fall. The simplest analogy to Austrians, like Mark Spitznagel, is the lack of controlled forest fires to eliminate old trees. That is, systemic excess and zombie corporations from central bank intervention and record liquidity, ultimately resulting in a catastrophic conflagration of epic proportions, a lack of creative destruction, sowing the seeds of the system's collapse. To Kochik, the natural equivalent is an avalanche. Whether one uses a raging inferno, however, or an avalanche as the analogy of what will eventually happen to the market, the message is clear. Every passing day that the market remains meta-stable adds to the violent whiplash that will be unleashed once markets inevitably revert back to their unstable disequilibrium in the near future. Thank you for watching this week's Sand to Pearls Stock Market Commentary video featuring the proprietary Bull-Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a happy Father's Day, a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.